Welcome back to another episode of Financial Planning Tips with Wall Street Alliance Group. My name is Makiah Hunt, and I am a Client Service Associate here. Today, I have Qihang Yao, Certified Plan Fiduciary Advisor, with us today to talk about backdoor Roth IRAs. So, Qihang, to start us off, can you please just tell us the difference between a Roth IRA and a traditional IRA and the contribution limits for 2025?
Thanks, Makiah. So the Roth IRA and a traditional IRA, they're both investment retirement accounts. And the difference between them primarily is the way that you would contribute and put money into them. So the Roth IRA, it's funded with after-tax dollars. So it's money that you have already paid income taxes on. Now you get out, you do not pay taxes on it. So very, very powerful retirement account here. Now with the traditional IRA, it's a bit more different. So you're funded with pre-tax dollars, so money that has not been paid income taxes on it yet, and it grows tax deferred. But after the age of 59 and a half, when you take the money out, you do have to pay income taxes on it. Now, another key difference is that with the traditional IRA, there's something called a required minimum distribution. So Uncle Sam knows that you can essentially, if there wasn't this, you can keep on deferring your taxes, not paying it forever. So as of 2025, at age of 73 or older, you are required to take some money out of the traditional IRA every year, and that is called the RMD. There's no such thing with the Roth IRA, so you do not have to worry about that. Now, for this year, the limit for both accounts is $7,000, and if you are 50 years or older, you can contribute an extra $1,000 for a total of $8,000 a year.
Great. Thank you, Chiong. So can you just explain what a backdoor Roth IRA is and what are the pros and cons of having a backdoor Roth IRA?
Sure. So another key difference between both these accounts is that as of this year, if you make more than $150,000 a year and you file taxes single head of household, you are not able to put in directly the full amount into a Roth IRA. If you make more than 165 a year, you're not eligible to put anything directly into a Roth IRA. If you are married, filing together, then if you both make more than $236,000 a year, you cannot put the full amount in. If you make more than 246,000, you cannot put anything directly into a Roth IRA. Now, the backdoor Roth IRA is a completely legal strategy that allows anyone, regardless of income, to put money into a Roth IRA, albeit indirectly. So to do that, you would put in the money into a traditional IRA, but this money would be post-tax, so money that you've already paid income taxes on. Now, would then immediately convert that traditional IRA into a Roth. And so that money would then grow deferred, grow tax-free, and then upon retirement after age 59 and a half, you would take it out also tax-free, as if the money had been in a Roth IRA the entire time. Now, the cons of this obviously is this may not be suitable for everyone. If you do have existing IRAs outside of this one, then when you do the conversion, there's something called a pro rata rule, and that complicates things, and oftentimes it defeats the purpose of a backdoor Roth.
Great. Thank you. So can you talk about the Roth conversion and how it works?
Course. So the key with the Roth conversion is what you're doing is you're taking pre-tax money, for example, money that's in an IRA, and you're paying the income taxes on that sum now, and then essentially converting that IRA into a Roth IRA. So you might ask me, Jihan, why would I want to pay all those taxes now? And the reason is that in times where the market is doing poorly and investment value is falling, so let's say they're in 2020 or 2022, in those times, the value of your IRA would likely be lower as well. So if you opt to pay the income taxes on that lower amount, you're paying less taxes and converting that balance into a Roth IRA, which then, when the market inevitably recovers, then that balance is in a Roth IRA. So when you take money out after age 59 and a half, then that money is tax free. Also, if you are in a lower income bracket, for example, maybe if you move to, let's say, Florida, where there's no state income tax, you can also consider performing a Roth conversion where you would pay less income tax. So just to summarize, Micaiah, the backdoor Roth IRA strategy is a very, very useful strategy. However, it may not work for everyone in every situation. So please consult with your financial advisor to see if this is right for you. Now, here at Wall Street Alliance Group, we are fiduciary advisors and we assist with all of our clients in every aspect of their financial planning under one umbrella.
Thank you so much, Qihang, for coming on for this week's financial planning tips with Wall Street Alliance Group, and we will see you next week.